Okay, the next item, we've got a couple of tax proposals out there. We have the president's, we also have one, the House Ways and Means Committee. Generally, that marginal rates would decrease, that now the top rate is 39.6%. The Trump plan and the Republican plan, you'd have a 12%, a 25%, and a 33%. Trump would leave the capital gains rate at 15 and 20%, 15% up to the top marginal rate and 20%. After that, the Republican plan would just say that whatever rate you're in, you only pay 50% of that rate for long-term capital gains. What that would mean for trading, that right now with Obamacare, if you're trading 60-40 products for everything over $450,000, you're paying 31.8%. The Trump plan, which would do away with the Obamacare tax, would be 25%. The Republican plan would be 23%. He's also talking about, or the president is also talking about decreasing corporate rates. Right now they're at 35%. That's where Lance was talking about double taxation. That there's talk that they would go down somewhere between 15 and 20%. If that was the case, then some of the ideas we kicked around here today about double taxation may be a little bit different. But again, that who knows where we're going on this. The one interesting point is that in both the House Ways and Means Committee tax proposal and the president's, he makes adjustments for flow-through entities, and that's because 99% of the new entities that are created are flow-through entities. Having said that, the proposal is to the extent that you would make money in a flow-through entity, and remember, you pay tax on it whether you leave the money in or take it out now. Thus the term flow-through. If you leave the money in, you would be taxed at a 15% rate. When you take the money out, you would have some incremental tax when you take it out.
So it's almost like imposing a corp-like structure.
It is.
Yeah.
It is.
Lower rates. But
Now, again, I suspect that these rules will be designed for what I like to call regular businesses, non-trading entities. But who knows? I mean, we've never seen this proposal before. Think about it, though, that if you could leave it in and only pay 15%, it would be pretty appealing because most trading entities are capital intensive. And the last item is that there's a brand new tax advice out by the IRS counsel's office that says FINRA fines are no longer deductible.
so try and keep your fines by the exchanges would be better.
But who knows? They might go one step farther. That it's our firm's outlook that if the CFTC or SEC would fine you, those fines are not deductible because they're a government agency. If the Chicago Merc or the Board of Trade fines you, those are just an ordinary and necessary expense of doing business and are deductible. This advice memorandum from the IRS that says FINRA fines are no longer deductible, I believe will be contested in court, given that some of the fines that we see out there.
And I think the fear with that is once you say FINRA is an instrumentality of the government, how is SIBO or CME or any other SRO,
or NFA.
NFA any different?
NFA would be a layoff.
They would be very similar. Yeah.